Welcome to the August 10th Market Structure Edge demo and discussion. And quick ground rules: if you're new, just mute yourself during the discussion and ask questions, either by the chat or just interrupt me. We want to make this as interactive as possible, as useful as possible to you. And so I've got, as I usually do, 5 things to go through. I will very quickly, in case you're new, I won't take a lot of time with this, but I think it's just a minute or two in case you came here and you said, boy, I hope this session helps me use the platform. Bear with me, you veterans, for just one moment, because we want to spend time helping you use the data to produce returns. And there's no perfect solution. I wish there were, but it's a very good one if you follow the data. And I will go through those things. To use the platform, the core basics are that we track supply and demand. So I'm going to talk a little bit about Antero Resources here in one of my points coming up. So I might as well use it. So when I say supply and demand, this is what I mean. This is the kind of stock that you want to own. You want to own this green part of the graph. And I got a note from somebody who said, I can't tell what the difference between the two. We don't take that into account sometimes. And I thought, maybe we need to. So I said the one that always stays between 1 and 10 is market structure sentiment, which is demand. And the one that doesn't is the other one, which is SPY, or in this case, AR. If you look at broad sentiment, it's SPY. Here it's Antero Resources. And so that's closing price. Demand is a 10-point algorithm metering buying and selling by investors over short periods of time. The short term is what determines prices. I wish it weren't the case, but it is. This is not private equity, it's public equity, and there are many, many participants with very short horizons like us. We're going to take advantage of those things. Below it is supply, short volume. It's the percentage of trading volume coming from borrowed stock. And so if you have demand that is if you drew a trend line here, it would be an uptrend, and it's spending all of its time at 5 or 10, between 5 and 10. And then the supply side is falling. The probability that you can produce returns is extremely high, extremely high. It's not perfect, but it's a great way to strip out all of the noise of the markets and focus on the basic economics of the stock market, which are supply and demand as they are in any market. And by the way, if you see this happen, it's 49.7%. You see that right up here? There, that's where you're going to see that number. I can't go there without changing it, but you can see right there, 49.7% of the volume, almost half of it is coming from borrowed stock. When it rises sharply, that's a good reason to take gains. Now, it might continue if you have a longer range. If you're trading short term, go find something else. If it's one of your longer term holdings, I mean, this is still excellent data. You could build a long-term portfolio, and I'm going to come to that in point number 3. But the point of this, supply and demand are what we use. The dashboard will contain 14 portfolios for you, including number 1, momentum, number 2, low volatility. I trade these things. That's what I trade. That way I don't have to think about it. There are 11 sector portfolios that will show you what all of the money in the market is doing, what the supply, demand, supply, what the supply demand trends are. Rising demand, falling supply, prices tend to rise. Falling demand, rising supply, prices tend to fall. Look at the financials or the 75% short portfolio. I just run that. I just create it, and it's tracking stocks that are 75% or more short. Look who's leading it, financials. I mean, at some point, we're going to have round 2 of that bank crisis. You saw that, I forget who it was, Fitch, I think, who downgraded 10 banks this week. I mean, it's just another little signal that those troubles haven't gone away. And you can create portfolios very easily. Put your own tickers in here, static portfolio, just type them in, add them, put a name on it, save that. You can track it. If you want to use our data, very easy to do. I'm only interested in stocks that have market structure demand equal to 10 because I trade momentum. And so this is what I want, and I want to want a really large supply-demand divergence, so I'm going to look for greater or equal to 2.5, that's 2.5 standard deviations. Add the rule, filter, you could name that. I don't know if we're going to find, see, we may not find anything in it. We'll see. We do. There are 300 stocks. Then you can narrow that down with additional criteria. But it's all about quantitative market structure data. So back now to those are the basics for today, because I don't want to consume too much time. I hope you won't mind. But let me now go back to make sure there aren't any questions, and I'll hit my points. Okay, might have to discount. Okay, did we get you back in? Brad, search for stocks that are new to a cent. How do I set that? Okay, Brad, nice to see you too. Thank you for doing this. I'll show you. So if you that are new to it, so what you want, it's very simple to do that. Go over here and say, I want market structure demand equal to, you could say equal to, if that's where you want it. You want to find the ones that are at 9 that have just gotten there, then you have to add another piece of the filter that says market structure sentiment trend is equal to up. I mean, it could be on the way down, it could be top there, it could be bottom there. But if you want to find it just getting there, that's what you want to look for. Now, realize that you may get a bunch of crap out of it too. So you might want to you could put in a price close to say, I want them only greater or equal to $20, let's say, because I don't want stocks that are trading at $1 or $2. And you may want more liquidity. You could add volume which is volume and liquidity are not the same thing. It's important to know. Volume is how many shares trade per day. Liquidity is how much you can actually buy. Volume can be made up of the same shares trading over and over, or it could be 80% short volume. I mean, you can buy, but you don't know. If it's 80% short, not good. It's artificial liquidity, and that can weigh on the price if any demand goes away. I prefer, it's not an absolute, but I prefer this because it's a much better indicator of liquidity to use dollars per trade. And let's say I like 3,000 because it puts it in the 1,000 most liquid stocks in the market. We may find nothing, but that's how you do it, Brad. It's pretty easy. And so you can filter it to test. And let's see how many we got. We got 15. That's a pretty good sort, actually. And so then you can name that. You can call it nines. Nines trending up. Every day, you will get a new set of those. And so that's how to do it. It's very simple. Realize you might want to sort it by supply to say, I want to get rid of those. How many of them? Look at that. 2/3 of them have short volume above 50%. Why does that matter? It's not an absolute, but we have found it to be very statistically true that short volume levels above 50% constrain returns. There are always exceptions. Tesla can spend a lot of time there. I could rattle off a variety of examples. So it's not an absolute, but as a central tendency, it is very true. It's better to have diverging supply and demand, particularly if the supply side is below half of the trading volume. It means more than half is actually coming from people who own the stock. And that's important because their horizon is longer. And so that's the answer to that. Okay, so
hey, Tim, one additional criteria you could add on there. You could put in the days at current sentiment, and you could put that at 1.
Oh, good point. Okay, so let's see, days
fourth one down, so days at current sentiment.
Good point. Equal to 1. And that'll achieve basically the same thing, right? I mean, I'm going to be, yep, that's a very good point. Thank you, Brian. By the way, I thought Brian's note today about shorting the market and the factors that affect it was very good. And he's got a really good perspective on things, and he's got a lot of expertise, and I thought you hit it really well, Brian. I want to talk a little bit about that too. Great point. I mean, all of these criteria, maybe I should just tell you, they're dollars per trade. That's a liquidity measure. Stocks trade a lot. The average stock in the S&P 500 trades almost 50,000 times a day. So if it trades $100 at a time, I'm going to get creamed trying to get in and out of it. At $3,000 a trade, algorithm, that's a meaningful amount. And so it's probable that I can get filled in and out without moving the price too much. So that's important. Remember to, if you would, just mute yourselves.
He's good in the morning, but he thinks he's leaving for southern Minnesota at noon.
Hey, let me mute you.
Later afternoon. Later. Okay.
Hang on. Okay. There we are. Sorry, Larry. I'm going to have to mute you. There you are. Apologies, Larry. Glad you're in, though. Okay, so really quickly, key behavior. There are 4 reasons money buys and sells. We're oversimplifying, but the stock market is a grocery store with consumers. Some of them buy story, active investment behavior. Twice as many buy the characteristics like market cap, volume, price, liquidity, sector, growth, value, quality, which can be a variety of financial metrics. That's a ways down, but there are those things that come into play. Fast trading, you'll see that in your portfolios. That's price, as the pursuit of price for short-term arbitrage profits, buying and selling at different prices, maybe in different places. And then what we call risk management, which is equity trades tied to derivatives, where the outcome is a desire to produce a return in the derivative. And it's a significant part of the market. That's the way we think about that. Market cap kind of explains itself. Demand trend, that's what market structure sentiment is. Price close just helps you weed out, you could home in on a particular range if you want to. Sector, days at 1, 10, 5, or 10, kind of interesting. Stocks that spend a lot of time at 1 might be good shorts. I mean, there's just no demand for them. So stocks that spend a lot of time at 10 oftentimes will capture the best performers that way. If a stock spent 10 of the last 20 trading days at 10, might have momentum. And so those are things we can look at. Short volume is the supply side, and you could track the percentage of it, the trend, the 1-day trend, and the 5-day trend. The Hicks rule, which comes from Steve. I don't think Steve's here today, but is stocks that get to 10 first time there. So days at current sentiment 1 or 10 and trending up, and supply ticks down day over day. Stock like that drops half of its volatility. I'll explain this in the how to trade momentum section. Those can be very good things to do. There is a time when it works and a time it doesn't, and the data will generally tell us. Supply-demand divergence is another way to find separations between demand and supply, and it's a standard deviation. Ticker, volatility, volume. Volatility, we'll talk about that in a little bit. Okay, so let's get to, I'm going to skip the first. I was going to talk a little bit about the broad market, but for time, I'm going to go on to what if stocks fall out of the portfolio? And I think it was Najee. I think Najee, you're here. I think you asked me that question. I got it from a couple of folks, but it's a very good question. What the question means is, suppose that an AR is a good example. Suppose I bought Antero Resources yesterday, and then today it's no longer in the momentum portfolio. And I think it was in there yesterday, as a matter of fact. What do? As long as it's in the portfolio, mathematically, you retain a good probability of producing returns. And I'll show you what I mean. I'm going to switch to the portfolio view here, and it's in, no, it's not in there. It should be in energy, right? So I think we can go down to gas. I don't know why that didn't work. Why didn't, because I don't know. That could be a bug. We may have just found one. I don't know. Okay, I know it's in here. Okay, here's Antero Resources. It's at 10 and top, meaning it spent more than 1 day. We know it spent a bunch of days there. 49.7% short, as we looked at. Trend, 30-day trend in the supply side. That will be a default 30-day view, is down. There's your price. Here's volatility. So it moves 4% a day between the intraday high and low. And so if you're buying something and it closed yesterday at 28.80 and it drops, call it 2%, and it's now at, what would that be, 27.40, thereabouts, 27.50. Maybe that's 27.75. So there's your entry opportunity. If it's down 2%, what is the probability that it might regain 2%? Mathematically very high, because we know it moves that way. And who does that? Machines calculate prices and do that. Machines are largely responsible for this. They don't take any risk. They're long, short, and they're supplying liquidity to the market. That's what they say. They're arbitrageurs. But we can use that to take advantage of the opportunity. And the question then is, and I'm going to switch examples now. And Fabiano, I think you sent me this. I'm going to use your example if you're here. What about a stock like Upstart? I won't lose my train of thought about what happens if they drop out of a portfolio. This almost reinforces it. What happens if you buy it on, let's say, August 3rd, because it's a 10, and look at the amount of time it's spent at 10, and the supply declines day over day, and you get stopped out, and it's down 8%, all of its intraday volatility. That's roughly what Upstart's is. Why does that happen? And here too we have, well, what happens if it drops out of the portfolio? By the way, if you see this, it drops from 10 to 9, even if the supply side continues to fall, you should get out. And notice that the stock ticked up a little bit ahead of that. If you say, I'm trying to get 4% and it's only up 2, get out. Just get out. You're better off. It may look, it could go up. I'm just saying mathematically that is a very, very consistent signal to leave. And that principle applies to a stock dropping out of a portfolio. I could take Catalent as an example. And I traded Upstart and I got stopped out of it. Why? Because momentum was over and I should have reduced my expectation. Instead of taking 4%, I could have very easily taken 2%. And I could have made 2% is a very nice return. I had a pretty sizable position. Instead, I got stopped out and I lost 50 basis points on it. That's worse, right? So here's Catalent. And Catalent was in the portfolio too. I want to say here, right maybe it was the 31st. No, it must have been here. It was a 9, rising, day over day supply declined. That should produce a return. And it might. But the moment it begins to turn, the probability, and it would have dropped right out of it was out of the portfolio on July 31st. Why? Because one of the criteria in the momentum portfolio is that you would have to tick down. If the supply ticks up, it's out. And so that alone, the fact that you go looking, what happened to Catalent? It's not in the portfolio anymore. Well, you should get out. It's not, again, that doesn't mean that it's going to drop like it did, and it may have reported results. But if we know mathematically that signal has changed, well, look, you can always find something else. You can't get back money that you've lost. So if you see that and you have you've bought it down half its volatility and you're hoping to capture 2, 3, 4%, and you see that, well, maybe you should just, even if you're just a little, just get rid of it and find something else. You're better off. You can always make money tomorrow, but you can't if you lose it today. And so that's, to me, the lesson is if it drops out of the portfolio, find something else. That will not apply to a longer term portfolio. Questions, thoughts, comments, observations, any experiences you want to share? Tim Coughlin or Dan Eisenberg or John Cook, you guys, if you want to have observations, or Barry, if you've got observations, please weigh in.
So, I really enjoy the fact that you let us take the portfolios and export into spreadsheets, because I track every day 3 portfolios: momentum, negative momentum, and low volatility. And you can see, and there's a maturity factor that I've found, right? For instance, PayPal, the last 3 days, it's been in my negative momentum. And, you look at Cat. Cat was a great example of the other day where it was actually down at the open, but it had a maturity of 2 days being in the momentum portfolio. So it had some maturity. So when it opened up down and hit its volatility point, you could step in and you got a nice run.
63 cents.
I think someone's talking.
I think so. Yeah, that's great input. Thank you, Barry. And I'll show you how to do that. I'm so glad you said that, because I had a note to show you how to export it. So you can, Look, I would like to, we have it on the development list to come up with a better way so you can go back and look what was in these various portfolios. But absent that, Barry is right that there's a very simple way to do that. And you look at PayPal, you could have traded it. Here's your opportunity to trade it long, and the moment it drops, the moment the sentiment drops, now you're out, you're in cash, right? And the demand continues to deteriorate, and then whoa, supply rises. Okay, right there, you could short that stock, right? And you could make money both directions. But you can clearly see why this stock is in Barry's reverse momentum, because the trend on the demand side is down, and the trend on the supply side is up, and way over trend here, and 54% of the volume. So that, again, it's not perfect, but those are pretty reliable signals, not because this math is a genius thing. It's because it reflects what everybody already thinks. So some people are doing the homework. The machines are trading the tick and saying, whoa, the supply-demand balance is deteriorating, let's short that. And so then we can use that to our advantage. What Barry means, and here's how you can track. If you want to know every day what's in the momentum portfolio, just export it to Excel. And look, it's not the greatest thing, but it does work. You just go down here to the actions and export to Excel, and you'll click that button, and it'll just give you the portfolio every day. But that's a nice way to keep track of what's, are the numbers shrinking? I watch that every day to know what the numbers are. So there you go. Now you have that. There are only 2 in it today, so it's a pretty small file. But then you can track the data. And
as you build the list every day, you can sort, obviously on the symbols in Excel, and that's what, immediately gives you the maturity.
There you go. Yep. Thank you for that, Barry. So, conclusion of the matter, Fabiano, Naji, Fabiano, if something drops out of the portfolio, my inclination is to remove it. Again, this applies to short-term trading. Let's now talk about longer-term portfolios. And I'm going to do 2 things to show you. If you just want to maintain something that it has a high probability of outperforming the market, you can use math to do that too. Two examples here. In fact, I think it's in there, so I'll just show you this way. I had this teed up for Benzinga on Monday because the bias to me, again, in the market right now is low volatility, not momentum, because there are there are only 2 momentum portfolio components today, VRT and Wayfair, I think. And that's telling us the absence of opportunities tells us the high risk in trading momentum. You might be able to do it. It's just that you have a much greater probability of getting stopped out, particularly if you're not willing to take just pretty small increments. Here's what I mean about a longer term portfolio. So notice that the demand here all the way across 5, at least, maybe a little better. You say, well, the supply side's rising. Yeah, it's rising all over the market. Now, I could go maybe find something else. I just want to use this as an example. Here's SLB. This was a core one that I wanted to point out. SLB was in the momentum portfolio. It was here because it had all the characteristics, and the supply side declined, demand's at 10, and it met the rest of the criteria. There are quite a number of those. So then it ticks down. Now the price, you might continue to get gains out of that, but I wouldn't continue to trade that short term because I'm going to trust the math, and the math is not always right. There's always an exception to the rule. However, if you had a longer term time frame, so long as this is well below 50, see, here's 50, and short volume's at 38.9%. Clearly, there's a long bias in SLB, and demand has basically since May options expiration has been 5 or better. You could hold that in a long-term portfolio, and it's done very well. That same principle apply. You could just move down the line here. McDonald's, I traded McDonald's last week. Because it had, where was that? I think it was here. It was, when did I trade that? I want to say it must have been August. I think that was it. So falling supply side, not by much, but a little bit. Demand right at 5, good entry point there, and I sold it the next day. I've limited out. Then I move on. notice that the math changes and it dropped out of the low volatility portfolio because the supply side rose. But for a long-term holding, that's still very good. It's a solid 5, and the supply side is very constrained again, 42%. So if you could just keep a portfolio, check it once a week, and say, well, is there anything in here that's above 50% short volume? Maybe I'll remove BP and Intuit, because they're both over 50%, and I'll find something else. You could do that in a longer term portfolio and deliver very steady returns that protect you from the movements in the market. And so it's just a way to think about that data. I think that it's highly likely, John Cook, I know you're good at this, to use the data for longer range thinking. It could also be the way that Brian Wilson described it in the Market Desk note today, where he's using broad sentiment to determine when to be long or short. And I'm right with Brian. I'm short the market right now because I think this is even more important than inflation data. We could be proven wrong, right? It's the risk we take. The inflation data is highly tradable right now, but the Dow went up 400 points and then returned all the way to zero. And it may end up negative today. I don't know what it's going to do. I just know that this and this do not tend to produce gains in the broad market. This does. If the demand side is rising and the supply side is generally falling, that will produce gains. And that's where you want to be long SPY. And particularly here, like you get these divergences between demand and supply, trade momentum. The momentum portfolio is going to tell us. There'll probably be 25 in it. Now you have a great chance to go capture really meaningful gains. The moment that changes, now and then probably the portfolios will tell us. Momentum opportunities will shrink, low volatility opportunities will increase. We reduce our expectation to a 1.5% gain. That's fine, maybe even 80 basis points. When it tips over, now we really have to shrink our expectations of long trades, because the supply side is at 50.1% and demand is right at 5. That is a net short market. It means there is a bias to the short side. Well, what's the probability of successful long trades? Well, they're there, but it will be much harder. And so rather than fight that, just go with it. I don't short individual stocks because my trading account currently is in an IRA, but I can trade short instruments like Brian, like you highlighted, SH, SDS, you know better than me. And those can produce good returns. Or you focus on low volatility trades. Why would those work? Because big passives, JP Morgan runs a tremendous amount of low volatility strategies that they weight using S&P 500 stocks toward things that don't move as much. Well, as everybody crowds into that trade, it can help those low volatility stocks rise no matter what the rest of the market is doing. And we're going to see that in the low volatility portfolio. Okay, one last thing. Questions, comments?
Tim, there's one question from Scott out there.
Okay. He's in today. Okay, good, John. I'm glad to see that. Sergio, yes, it's being recorded. I intend to have that out in Friday's note. So that's my aim. Martin, good to see you. And thank you for weighing in. Okay, Scott. Is there a way to backtest? And Scott, thank you for, I can't swear, but you might have come through Interactive Brokers, right? Is there a way to backtest a portfolio's performance? And if not, will that feature be forthcoming? It's a very good question. We have a blunt instrument backtesting engine, but it doesn't test a portfolio. So you're right about that. We have a beta project that I have been testing a lot. That's a performance profiler. And, we've got one of so this hedge fund performance, it's right now a very, very simple routine. Yeah, it's a utility, and I have to use JSON files to populate it because we are very agile developers of software. Been doing it a very long time. And we get this thing dialed in, we'll supply it so that you can run performance data on a portfolio. But I've run a lot of performance data using different criteria, low volatility, momentum, different periods in the market. What I've found is that the way to really win is to avoid the times when the broad sentiment has risen over 6 and you wait to come back into the market till it has bottomed and rises again. And if you do that, the returns are really pretty extraordinary. So that was a long-winded answer. It says partly and not great. And yes, we will, as we refine this, we will offer it to users. Okay. Last thing I've got is, because I said we talked about it, is and I've sort of touched on it, is I said in market desk notes that we would talk about it is trading momentum. And I think this goes back, was it Najee again? I can't remember. Apologies. I get a lot of emails and I don't remember precisely, but back to Upstart and momentum and when it works and when it doesn't. And I'm just using Upstart because it's an easy example. Upstart has a lot of volatility. And why did it work so well? Through here, we had a lot of opportunity to trade it. If the supply side rises, price doesn't do as well. Supply side drops, price does very well. Demand has stayed the same. That's why the supply side is so important. So to trade momentum when those conditions are prevailing, broad sentiment is rising, supply is constrained. A lot of components in the momentum portfolio trade half the volatility. You buy something when it's down half its volatility. There are other approaches. This is just a very statistically viable approach. And then set your limit up some portion of that. And if Upstart moves 8% and it goes down 8%, you ought to be able to make 4, right? Under those conditions, yes. And in fact, you could argue you could hold it in your long-term portfolio the whole time it's a 10 until here. Would you have made money? Yeah. I would say you leave here. When you see the supply side shoot way up above the trend, if the trend line is, call it 42% and it jumps to 46, that is more than a 10% move. And you should probably leave. The price is going to deteriorate. For short-term trading, why didn't this work? Because all those factors broke down. There was no longer momentum in the broad market. Broad sentiment was falling. The supply in the broad market is rising. Even Upstart had this huge jump on the supply side. You go back wherever there's a big jump above the trend. You say, well, the trend it's at the moment. How do I use the trend? Well, I think you just use the trend at the moment. Yeah, it's going to be different at different points along the continuum, but that clearly is a signal that performance will be degraded. And it's what I mean about how, you get stocks that are 50% short, it degrades. It's a predictive indicator of falling future performance. It may be short term, only 4 or 5 days, but that's why the trade stopped working. It's not anything wrong with the data. There's nothing wrong with Upstart. It's that the environment changed. Okay. Makes sense? Otherwise, trading momentum works. How's that? Tens, falling supply, trade volatility, take half the volatility, set your limit up half of that. So if your entry point is 45 and you want to make 2%, what would that be? Call it 46.15. And you put your stop in at 44, 72. and because you don't want machines to move it through your stop, and they're aware of where those things are. But you want the probability to be in your favor that they're going to lift it up to your point, take that gain, and repeat it. That is a very statistically viable way to produce returns. Okay, last thing I have, and we're going to wrap, is ahead, context. And Brian Wilson, you mentioned it today. Options expire next week. Oftentimes when the market is bottoming, if sentiment were to bottom into expirations, oftentimes the market recovers out the other side. The question mark this time is going to be, because that didn't really happen in July. You look back in 2022, this happened too. It could be we keep going. I think the market has a downside bias here. Now, I can't swear to, I don't know, anybody who makes some prognostication will be rendered a fool. But I'll tell you my concern. Here were options expirations in June, and it was a peak for the market, and the market declined. And then we had index futures expiring at month end. That was a pretty good point for entry. We get to July expirations, actually a peak, but the market, has been very durable. We're coming into August expirations. Will it bottom and rise again? Well, I don't know. To me, the fact that the market has continued to run from here all the way to futures contracts here means there's a higher probability that money is less disposed to continue to buy equities. Look, I don't know, but you just beware of that context, that options expirations in August are going to be important. If people don't reset hedges and recommit money to the market, we could go right down again. I'm not predicting that. I don't know what's going to happen. But if you look back historically at these levels of, the high levels of short volume, just year to date even, it's better to even go back further. But see how high our supply side is? This was tough for stocks that, really struggled with high supply. Here was the worst time when supply was way up here at 52%. And then it declined. The market recovered very nicely out of the banking crisis. Where are we now? Well, the trend's fine. But if this were to continue up and it doesn't have a whole lot further to go, I would be concerned about it. May be a market to short, but we'll look at the data, and the data will tell us. If this improves, then we're fine. If it does this, the market's gonna find. It could test this year's lows, not the full low. I don't know, but you can see the data, right? It look like these trends are not moving in a direction that signals further gains for the market, at least near term. So we'll see. Okay, that was we covered a lot of ground, plenty probably for today, right? Dan, I've got you on the docket, Dan Eisenberg. For that issue you raised, we're going to figure it out. So, yeah. Well, bear with us.
My system is a little funny, so we may be chasing something that's really just specific to me.
We are not encountering it. Yeah.
I also have trouble when I form a screen. It doesn't. I have to do some funny things to get the entries to be able to, accept them, check them, get them in the screen. So there may be something in my system.
Sounds like caching. I mean, most of those problems are caching issues, and of course, we're using Kubernetes clusters. That's what we use out of Microsoft Azure, and it's good, but it's also quirky. Yeah. So maybe there's a clash between the systems, but we'll see. We've got some smart people who can sort that out. I hope.
It's not a big deal for me.
Okay. All right, you guys, good to see you. Thank you for taking the time, both of you veterans and the new folks. And I will look forward to seeing you next week, which will be right into options expiration. So it'll be pretty important to see where that data is, I think. Brian, did I miss anything? No? Good enough?
You're good. Mm-hmm.
Okay. Thanks, guys. Good to see you all.
Thanks, Tim. Appreciate it.
Back at you. You bet, Barry.